Hey traders, this is Blake Morrow with Trader Summit, and it's Friday, and I have Mr. Jim Welsh of Macro Tides. He's joining us as he always does on Fridays. Well, at least we try to do it every Friday. Jim, how are you? Good to see you.
I'm good. How you doing?
I'm doing well. I'm not doing it as well as the market is at all-time highs. Once again, it seems like another week, another rally to all-time highs, following the CPI. So, what'd you make of the CPI data that came out this week?
Well, we touched on it, discussed it last week. The anticipation was that we were going to see the inflation numbers, both headline and core, decline. The only question mark was it going to be 1 or 2/10. It was 2/10 on the headline, 1/10 on the core. And as I wrote in this last week's Monday Weekly Technical Review, we could pretty much be assured that Wall Street would jump on this and start to raise the odds of Fed rate cuts. Now, in my view, the better CPI report doesn't change anything in terms of monetary policy. The Fed has repeatedly, as Powell, also has noted many times, we need greater confidence. 1 month good number isn't going to provide that. But, technically, the market was in good shape. We talked about the advanced decline line last week. It had made a new high last week, which kind of, in my mind, implied we're going up. I mean, you're going to get good news. Internals are decent. I thought that the dollar would weaken. Obviously, it did. We would see treasury yields come down, and we would see gold rally. And, to me, the CPI was going to generate all that. And obviously, it has.
Because it wasn't, I mean, it could have been worse, right? That's the attitude. The CPI could have been worse based on all the sticky data that we've seen globally.
Well, the people who know very little, were surprised for 3 months when it kept ticking up. You and I talked about that every single month, why it was going to tick up. And so, yeah, they're bracing for something worse when they really shouldn't have been. And that's why, we made a point to talk about it last Friday that, hey, folks, this thing is set up to come down and that it would, quote unquote, surprise those who don't know, which it did. Now, we're going to cover the CPI in a little bit. But, when the May CPI comes out, it's not going to be as friendly. But
yeah,
so,
all right.
Anyway, this was kind of predictable, Blake, in the sense that, remember 3 weeks ago, people were, oh, my God, the Fed might actually raise rates. And as we talked a few weeks ago, it's like, there's no way the Fed is raising rates. So, I think we've done a really good job of really nailing where the Fed was at, what they were likely to do, what they were not likely to do, and how the markets respond to that. So, higher for longer is here to stay for a while. And ultimately, is that going to have some bearing on the economy? Of course it will. But in the near term, everything was set up for, the kind of moves we just talked about.
Right. And before we get into some of the charts that Jim has brought, let me just make mention of this. You guys listen in every week here on Trader Summit. Make sure you give us a thumbs up, subscribe to the channel, hit your bell icon there. These are all free things that you can do. Hit your bell icon so you're notified when Jim, his video comes out. Jim, you got quite a big audience that's starting to listen to you every single week, understanding that your concepts of putting it all together for them. So kudos to you. Now we're going to get into some of the charts that Jim brings every single week, but do him a favor, request a technical review from Jim, email him at jimwelshmacro@gmail.com. And request one, say you heard us here on Trader Summit, and he'll take care of you. So Jim, I did the pitch for you. So there you go.
Thank you very much.
You're welcome. Let's go into some of the charts.
I'll send you the money on Monday.
Thank you. $5 if you can leave it next to the toilet. I'd appreciate it. All right. So
yes, sir.
We have this surprise index. Tell us a little bit about what we're seeing here, because it doesn't look pretty.
Okay. So basically the economic surprise is put together by Citibank. And, they take all the estimates by Wall Street economists, and then they compare it to actual data. So understanding how this thing evolves is kind of important. So after a string of negative data, what happens is economists run down and they lower future expectations, which then means it's a little bit easier for the data to come in less bad. And so the economic surprise index, which is the bluish line, will go up. And once you get to a point where, gee, things are looking really pretty good, economists then amp up their estimates for the future even higher. And guess what? That sets the table for the numbers to come in
Right.
less good and miss.
Yeah.
The point I would make is on the left-hand scale, you can see that this thing goes from like a -80 to a +80. So if economists were like perfect, which, hey, none of us are, but the amplitude of the swings, if they were more accurate in terms of their forecasts, would be a lot more narrow. In other words, instead of plus and minus 80, maybe plus or minus 35. All right. So this underscores how bad they are. The second point is the black line is the 10-year Treasury yield. And Treasury bonds are trading off of estimates of economic activity. So as these guys ramp up estimates, because recent data has been good, guess what? Treasury yields have a tendency to go up. And then it's like, oops, okay, data isn't coming in as good. Treasury yields come down. So we've had a string over the last 4 or 5 weeks, and we've talked about a number of these points, the ISM survey, the services number, the retail sales yesterday, that have come in missing. And what that implies is supportive of Treasury yields coming down more. And the irony here is Wall Street is more convinced, I think, almost ever, or at least the last few years, that we don't have anything to worry about the economy. At the same time, we're seeing data point after data point consistently coming in less than what was estimated. So to me, this is supportive of obviously a rally in Treasury bonds. At some point in time, Wall Street will pay attention. The other thing I point out, like a chart, okay, of a stock that makes higher highs, higher lows, we say it's in an uptrend. Well, look at this thing bottomed in the summer of 2022, and the lows were higher, the highs were higher. But look at, in the last 2-3 months, we made a much lower peak than where it was in January. And we've taken out the prior low. So to me, just, analyzing this increases the odds that we're likely to see more data come in a little softer than expected.
So what that means for Fed funds rate is?
Well, I don't think the Fed's doing anything because the economy continues to grow north of 2%, which is above its potential. But this chart is looking at changes in the federal funds rate. And going back the last 40 years or so, it's showing that there's about a 2-year lag. So when the Fed starts raising interest rates, about 2 years after those increases is when the unemployment rate starts to tick higher. The chart on the right captures the point I made in last Monday's weekly technical review. If you remember, back in June, July, September, and November of 2022, the Fed increased the funds rate 75 bips at each of those meetings. So it went up 300 basis points in less than 5 months. So that is what I think the brunt of that is what we're likely to see begin to impact the economy as we get into the third quarter, towards the end of this year, the downward pressure from those rapid and significant increases on the economy. And hence, I think we're going to see, when we get in the second half of this year, we're going to see the unemployment rate tick higher. Initially, it's going to be very gradual. I don't think it's until later this year, early next year, that it will likely accelerate. But that's, to me, the message of a chart that goes back 50 years, pretty darn consistent. And, it's ironic again that right now, very few on Wall Street are worried that the economy is going to slow in a meaningful way.
But Jim, don't be a worrywart. I saw weekly unemployment claims this week. They weren't that bad. Don't freak me out right now. What else? What else you got?
Well, here's the thing. This is where technical analysis can be helpful because, as I noted, and we're going to look at the advanced decline line, it's making higher highs.
Yeah.
And historically, when the AD line is making higher highs, can you get a 5% correction? Yeah, of course. We were looking for one in April. It happened. But the AD line made another new high yesterday. So until we start to see in a sense, the economic data get negative enough that the sectors that are most sensitive and more cyclically orientated start to weaken, and then that translates to a weaker AD line, to me, that's when it's time to get more, if you will, bearish on stocks. We're not there. But the idea of these charts is, okay, let's look out the next 6 months. Let's try to figure out what's coming that's counter to what the narrative is right now. And then to me, that's where that's helpful. But the roadmap is provided by the technicals of each of these markets.
Right. Well, before we jump into all that, let's talk
Yeah.
about retail sales, because that did have some that got everybody's attention, right? So,
Yeah,
what did
a
you
little
see out
bit.
of that jumped out at you?
Well, this is the control group. So people, it's kind of like we have headline inflation, core inflation. Well, this is like core retail sales. So they don't include things like gas stations, autos, because they're big ticket. Food is obviously something people need and so forth. Anyway, but if you look at this chart from left to right, and if they did, and I just forgot the word, but anyway, if you drew a line connecting, if you will, where most of these data points are falling above and below, the downtrend is kind of evident. And the thing I would note is of the last 4 months, 3 of the 4 have been negative. Now, that doesn't happen very often. So again, these are creeping signs that the economy is indeed slowing. It's not dramatic. I wouldn't expect it to be dramatic at this point in time. At inflection times, unless some big event happens, it's gradual. And then as it takes and reach, if you will, critical mass, which is typically when unemployment starts ticking up, that's when data starts to accelerate and become weaker. We're just, again, these are just signs that are saying, folks, everyone's bullish the economy, and there's more and more signs saying, you know what, we're nearing an inflection point.
All right. Well, you already talked a bit about it, but here's your CPI breakdown. So,
yeah, again, it was just, knowing what the number was 12 months ago is a big heads up. So we knew that 43 bips was getting taken off from April of 23. And I thought, okay, if you add 30, the CPI is going to downtick. And I think it was 31, which is why they rounded it up to 3.4. From down from 3.5. And then the core was 47 bips from April of last year, and it came in at 30 or 31, so that downticked. But the thing I would point is, let's go back real quick if we can.
yeah,
Like,
sure.
because look at May. The takeaway value for May on the CPI is 11 basis points on the headline. So let's say the CPI comes in, and hey, it continues to moderate, only goes up 25 bips. The year-over-year number is going to tick back up to 3.5. And the headline or the core is 36 bips. That's going to be a push. So my point is, knowing what's coming when these data points come out, and then you look at where the technical setup is on various markets, I think can be really helpful. It was obviously very helpful this past week.
All right. Well, Jim, I'm sure, people understanding this concept that you deal with CPI, it's like, getting a PhD in economics. I think you'd be a great coach for some people on some of these things. Let's talk a little bit about the dollar. How you feel it's all going to factor into the dollar here?
Well, for weeks, the expectation was that we were going to see the dollar decline. And obviously the weaker data, both the CPI, some of the other numbers that came out, softer. Dollar, spiked down. It's getting a little bit of a bounce. I believe that after this bounce, it's headed lower. And ultimately, I think a decline below 102.50 or at least 103 is coming. And, again, to me, in terms of looking at the chart pattern of the dollar, it looks like it's going to go down more. Well, what might cause that? Well, softer CPI, softer economic data, so everything lined up pretty well, obviously.
Jim, and I'm going to say, I was not convinced about this at all. Although I did get short dollars over the last couple of weeks, and me personally, I'm going to attribute that some of my decision making was listening to you here, as I was not convinced. Now I still need some convincing that equity markets are going to go down and the dollar is going to fall at the same time. I haven't got there yet, but
Yeah.
I do see that you have a lot of support levels that are coming into play ahead of this.
Yeah, there should be a
triangle.
bounce. And if this is a triangle, we finished wave D, there will be a bounce for wave E. And maybe we get a little period of time where the data comes in okay. But I think by the end of this year, this pattern should be complete. and I believe we're going to see the dollar break down.
Okay. Well, I need more convincing about that, but that's all right. That's why you brought
That's all
all
right.
these awesome charts.
1 week at a
Gold,
time, right?
yeah, one day, 1 week at a time. So gold is making its move higher, and silver broke out today above 30, and gold looks like it
Yeah.
wants to do the same.
Yeah. I mean, again, the expectation was that we were going to see gold rally above 24.27, maybe make a run towards 2,500. That's what I wrote about in this, really the last two weekly technical reviews. And, everything's lining up, so if and when the dollar completes this phase of the pullback and is getting ready for a bounce, well, that will be the time probably we'll see gold top out and then begin to have its own correction. But near term, it's positive. And, that 2335 is that downtrend line we broke out. Obviously, you break out above something, you're not supposed to then quickly break below it. So I don't think we have to worry about that given the strength today.
All right. Well, TLT, a little bit of a question mark. I think we're at an inflection point. If you look at like the 10-year, the ZNs, which these are basically them, in ETF form. I guess it's that right, ETF form. We're at previous support, current resistance, up against some your wedge resistance. What do you make of this? Does it reverse or?
Yeah, I think we're going to pull back. I mean, in Monday's weekly technical review, my belief was we were going to see TLT rally to a higher high based on the CPI report, come up to that downtrend line, and given that would complete 5 waves up from the low at 87.34, you've got natural resistance, both that downtrend line, as you also pointed out, the horizontal resistance for a pullback. But let's review quickly. A few weeks ago, it was like, hey, we're going to look for a lower low below 87.79. It happened. RSI, positive divergence. Then it was the question, will we see the 5-day exponential, the red line, cross above the green line? It did. And so to me, one piece after another, and maybe the most important piece is 5 up. In my view, this is wave 1 of a rally that's going to take TLT above the prior high in late January, 100.57. I think 105 to 109 is a reasonable target for this wave C. So to me, this is wave 1 up. We'll get a wave 2 pullback. You can see there's a gap at 91.24. The 382 should have the 382 in there, because they may not cut that much deeper. But my anticipation, Blake, is you get this pullback, it's a pullback to buy, because the next move up will clearly break that downtrend line and then run. And I'd say the initial target is that 96 area that will come into play. So for me, I was looking for a low to take place in Treasury bonds, and piece by piece has fallen into alignment with that expectation. So I just think you got to buy bonds on weakness in anticipation of, at least a 10-point rally and maybe, 15 or more. Again, the overall view is the economy is going to slow more than people realize. And if and when that happens, TLT is going to be a big beneficiary of that.
All right. Well, the last couple charts you brought, first of all, you got S&P advanced decline line. So what are we seeing here?
I just, again, what I pointed out last week was that the AD line had made a new high. And, that's, to me, meant the trend is higher. We were likely to get good news on the CPI report, which implied the path of least resistance was up. We've done that. And, as I said earlier, until we start to see the AD line show more wear and tear, one has to be, constructive on the market. Now, the next chart, I think, kind of more of a near-term roadmap. Last week, I said, I think given what we just talked about in terms of AD line, CPI coming in, we're in wave 3, and that, should push the S&P up to a higher high. It has. I think there's a good chance that the high yesterday was wave 3. So we get a modest pullback. as I note, there's a gap at 52.50, then to me, there's another push higher. Once we finish that next rally, then we're going to have a deeper pullback. And, we'll cross that bridge if and when we get there. You can see this is a 2-hour chart, by the way.
Yeah.
And you can see we're overbought. So a modest pullback that takes a few days will get that oscillator, obviously far away from being overbought and closer to the green line, which is oversold.
So, Jim, you say end of days is coming in within 2 weeks.
Not
Just
quite.
putting words in your mouth. Just putting words in your mouth.
No, we got to have fun here, man.
Yeah.
No, again, the benefit, as I said earlier, you look at economic data, and if the data is aligning with the narrative, we don't have to worry about a recession. Hey, copacetic. But when the data starts to deviate, that's when I think people have to be on guard. And that's where looking at the technical stuff kind of helps us time inflection points in the market as people wake up to the news. And we saw, in a sense, a mini version of this past week. People were surprised that the CPI really dropped. Well, they shouldn't have been, but they were. And in anticipating that meant the market was going to rally, the dollar was going to weaken, and so forth. So anyway.
Well, Jim, I for one appreciate you. Like I said, I'm gonna thank you for keeping me on track with the dollar. I wasn't really a believer, but then things started to fall into place, and that's the thing about using yourself and other people that personally I listen to and I respect. When you can get multiple modes of confirmation, confirming an idea or a thought process that you have. That's what helps you have the confidence to take positions in the market yourself. And that, I think you provide that with our traders every single week. So if you guys and gals enjoy your time here with Jim, thank him a couple different ways. Give him a big thumbs up. Jump down in the comments below if you don't agree with him. And also, send him an email and request a technical review from him so you can see what he actually does. So Jim.
Yeah, I mean, in the written reports, I go obviously in greater detail.
Yeah.
I explain some of the methodologies that I'm doing. So if someone is interested in trying to learn more about both in terms of how to integrate fundamentals in the economy and technical analysis, I've gotten nice feedback over the years from people saying, you break difficult subjects down to make them understandable. I love doing this. So thank you very much. I'm glad I've been a benefit.
Macro for dummies. Macro for dummies.
Well, I don't usually wear my dunce cap when we do these things, but the rest of the week I have it on, right?
Jim, anyway, I want to thank you for being with us every week. I look forward to catching up with you next week, and I'm sure our entire audience does as well. So have a great weekend, and we'll see you next week.
You do the same, and stay well. Thanks, Blake.
Jim. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.